A merchant wakes up to find their account suddenly frozen, payouts are paused while the processor reviews activity, chargebacks are climbing, and most mainstream processors say they aren't structured to support that model. It looks like the end of the road. But a few months later, that same merchant is processing thousands of dollars a day, approved by a specialist processor, and scaling faster than before. Something clearly changed. Here's the part that gets interesting. There are processors out there that don't just accept high-risk merchants. They actively serve them. If you're a referral partner or a software platform trying to unlock a more profitable angle in payments, stay with me. Because what you're about to learn could become your most valuable opportunity in this space. Let's bring some clarity to this. First off, what exactly is a high-risk merchant? In simple terms, it's any business that traditional processors see as having more uncertainty in their transactions. Maybe they experience higher chargebacks, operate in tightly regulated spaces, serve international customers, sell high-ticket products, or run on recurring subscriptions. Basically, anything that needs a closer look during approval. Think of industries like CBD and hemp, subscription boxes, travel bookings, supplements, or peptides. These are sectors most mainstream processors aren't structured to support, often because of higher risk factors or their higher transaction variability. But here's the opportunity. Specialist processors want those merchants. They know how to measure and manage the risk, price it correctly, and profit from it. While everyone else is saying no, they can confidently step in, say yes, and build long-term, high-margin relationships. And this is where you come in. Suppose you're a referral partner or platform already serving merchants in these categories. In that case, this is your moment to get aligned with processors who can actually support them, so your introductions lead to faster approvals, fewer dead ends, and stronger revenue on every deal. More importantly, you'll learn how to turn simple connections into ongoing profit by matching the right merchant with the right processor. Let's break this down step by step. I'm going to walk you through 4 key parts, and the last one is where everything comes together. Stick with me until the end. So let's start with the first one. What actually makes a merchant high risk? Imagine you're looking at 2 businesses. One processes mostly card-present transactions in a retail shop. The other sells CBD products entirely online through card-not-present payments. Even before factoring in industry type, that alone creates a split. Card-present transactions are naturally lower risk because the customer is physically present, while card-not-present transactions carry far higher dispute and fraud potential. Add the industry layer on top of that, and processors treat them completely differently. And as I had described earlier, some industries are simply labeled risky. They've had higher refund and chargeback rates, and they often sit in gray regulatory zones. So even when they're legitimate, they still signal items that require context and underwriting. Next comes the business model. Think of subscription-based offers, fitness plans, supplements, or coaching programs. Customers forget, cancel, or dispute charges. Every dispute adds risk, and too many can place the account under review. Then there's the merchant's chargeback history. Most processors set a limit around 1%. Cross that line, and you're under review. Go much higher, and platforms like Stripe or Square might pause payouts while reviewing activity. Volume and geography matter too. If a new business suddenly starts processing $100,000 a month across multiple countries, that can look volatile. Big payments or cross-border transactions multiply risk, and processors take note. All these factors, the industry, billing model, chargeback rates, transaction patterns, and past history, come together to define how risky a merchant looks on paper. And this is where high-risk processors come in. While mainstream companies back away, these specialists lean in. They study the details, price the risk, and make approvals possible where others can't. They know how to turn what looks like a problem into an opportunity. Now, you may ask, if these merchants are risky, why would anyone want them? The answer comes down to business logic. High-risk merchants come with higher fees, protective reserves, and stricter terms, which means bigger margins for the processor. A regular merchant might pay around 2% per transaction, But high-risk accounts can face 5% or more in some cases. There's also the competitive advantage. Most processors won't touch these merchants, which gives specialists a defensible niche. They can dominate certain verticals, negotiate better terms, or even secure exclusive deals that mainstream processors can't. On top of that, these processors offer value-added services that create even more revenue opportunities. Things like fraud monitoring, chargeback management, and reserve oversight allow them to expand services and retain merchants for the long term. Finally, specialist processors are experts at reading the data. They know how to underwrite carefully, segment risk, and use chargeback history or vertical-specific knowledge to approve merchants who might look too risky to others, but are actually manageable. By understanding the details, they turn what seems like signals that require context and underwriting into a profitable relationship. At this point, a real-world example could really help you see how this actually works in practice. Let's suppose a US-based travel ticketing site. Because travel deals with a high ratio of cancellations and refunds, it's considered high risk, one that mainstream processors aren't structured to support. Now picture you, the referral partner. You're a CPA with several merchant clients in travel who know the challenges these businesses face. You refer this merchant to a specialist processor that understands high-risk verticals. The processor begins underwriting. They request 6 months of bank statements, chargeback history, the merchant's refund policy, travel certifications, and website terms and conditions. You help the merchant get all of this organized and ready, and that's your role in the process. The processor then offers pricing that reflects the risk. It could be maybe 4.5% plus 30 cents per transaction, along with a 10% rolling reserve held for 6 months. Let's break down the numbers. Suppose the merchant processes $100,000 per month at 4.5% plus 30 cents per transaction. That works out to around $4,800 in processing fees each month. Here's where it gets interesting for you. As the referral partner, you receive 10% of that processing revenue for the lifetime of the merchant, roughly $480 per month from this one client. Over a year, that's about $5,760 in passive recurring income, and the upside multiplies quickly. If you refer 10 similar merchants, you could be earning around $57,600 per year, while the merchants gain access to a processor that mainstream companies would rarely approve, and the processor earns healthy margins. It's a classic win-win-win. The merchant gets approved, the referral partner earns recurring income, and the processor profits from taking a calculated risk. So how do you actually tap into this as a partner? There are a few practical steps that can make the whole process easier for everyone involved. Start by giving merchants a simple go kit before you refer them. Things like website compliance, clear terms and conditions, accurate business details, and a working checkout flow. When those basics are in place, approvals usually move along more smoothly. Then focus on the industries you already know. And if you've worked with travel, CBD, supplements, coaching, or similar categories, start there. When you understand the space, it's easier to recognize good fit merchants and make introductions that actually land. From there, keep your role straightforward. Connect the merchant with the ISO or processor and let their team take it from that point forward. A clean handoff is really all that's needed. It also helps to have a clear referral agreement so you know exactly how you'll be compensated and where to send opportunities. Once that's established, the processor handles the rest. If you run a software or service platform, you can even build referral pathways directly into your system. That way, your users can access processors suited for high-risk approvals without adding extra work on your end. Once you've made the introduction, your job is done. The ISO or processor will handle onboarding, underwriting, and ongoing support. Your role stays focused on connecting the right merchants with the right partner. And over time, you'll naturally see which types of merchants convert the best. Leaning into those areas helps you build a consistent steady stream of referral revenue. But remember, high risk doesn't mean no risk. There are a few things you need to watch carefully. First, rate creep and reserve changes. Some accounts start with one set of fees or reserve terms, but if chargebacks rise, those numbers can increase fast. Always make sure your merchants understand this from day one, so there are no surprises later. Next, there's contract churn. If a merchant starts breaking compliance rules or running into high chargebacks, the processor may pause payouts while reviewing activity or terminate processing. That doesn't just hurt them, it can also cut off your commissions. So always work with processors that have a proven track record and transparent policies. Merchant selection is another key point. If you refer anyone and everyone without proper documentation or background checks, it can backfire. Processors want reliable partners. Protect your reputation by only referring legitimate, prepared businesses. Then there's compliance and regulation. High-risk industries change rapidly, so it's important to stay informed, allowing you and your merchants to adapt before issues arise. And finally, always talk about reserves upfront. Rolling reserves are common in high-risk processing, but they can impact a merchant's cash flow. Setting expectations early helps avoid frustration later. Being proactive here is what separates good partners from great ones. When you understand the risks, manage them well, and keep your merchants informed, you build lasting relationships and a business that keeps paying you month after month. So if you want to turn high-risk approvals into recurring income, start by understanding how the referral model works. We put together a simple breakdown that explains how partners earn and how specialist processors evaluate these merchants. It's linked below. Comment "Guide me" for a free step-by-step breakdown. The knowledge is out there. You just need to act on it. Thanks for watching Profits from Payments. Hit like and subscribe for more finance deep dives. Remember, money never stops moving and someone always profits. Make sure it's you.